Right, traders, welcome back. In this video, we're going to be going over the concept of a point of interest, right? So a point of interest, you can either have a bearish point of interest or a bullish point of interest, right? So here we have a bullish point of interest just over here. So I'm going to label this in green to start off with, right? So what do we mean by a bullish point of interest? Well, when price has been giving us bullish market structure, we see higher highs and higher lows and higher highs and higher lows and higher highs, right? Our job is to essentially buy off a bullish POI. But what actually makes a bullish POI, and how can we identify high probability POIs? Well, it's something like this, right? So there's a few rules and a few confluences we can use to our advantage, right? So the three rules, I'm going to quickly go over them because most people should have an idea if you've been following my videos on the channel. And I recommend everyone just subscribing in, right? So once you've had a break of structure to the upside, right? The next thing you're looking for now is you want the market to give you its pullback, right? So you want to see the market come down. Don't try and force this top over here. Once you see the market coming down, you then want to ask yourself, where are the premium and discount arrays, right? So when you have a structural low down here and you have a structural high up here, right? Now, this is the 50% level over here, right? The thing I want people to take away is that the equilibrium essentially delineates anything below that being a discount, right? And any bullish POI must lie in the discount, right? Because we want to be buying low and selling high. So when we get to areas of demand, right, demand zone or bullish POI, we should be looking to buy from this region, right? But the final thing we want to understand, right, so we've had a break of structure over here. This is kind of like rule number one. Rule number two is we want to be in the discount below this 50% level. Now, our third rule is that we want to have price leaving an inefficiency or a fair value gap, typically around the region, definitely below the equilibrium or the 50% level, right? So with this in mind, we're understanding that we have our three rules when it comes to bullish POIs, right? Now, when it comes to confluences, the biggest confluence that people often shout about, and they are correct, is the concept of inducement, right? So when price does eventually come down, what makes a higher probability POI is when we see price engineering liquidity, the way it has done over here, before ultimately mitigating that POI and then heading higher, right? So what we're doing is we often slow down here in price. This is sometimes known as an accumulation or a Wyckoff accumulation, where this zone over here, this orange zone, builds liquidity in the markets, right? So this now is sell side liquidity, right? Sell side liquidity, right? And then when we see price engineer the liquidity, then mitigate this POI, it's filled a fair value gap over here. It's swept liquidity, so it's essentially, you can look at it as a car that's taking fuel. It's fueled up, it's gassed up after taking this liquidity before ultimately heading higher, right? A quick note to understand is that this is a weak structural high. And the reason it's a weak high is because as price does start to push up, as the demand starts to kick in the markets, we have a weak high over here as it's failed to break the low, which is down here. So with this theory in mind, let's just take it to the charts over here and understand what I mean by an inducement, right? So if we look at price action over here, again, this is daily time frame on the euro dollar, right? So let's just cut price up, right? Everything here is obviously through backtesting, but we understand backtesting allows us to develop our strategies. So if we just play price on, we understand quickly over here, we have a structural low down here, and currently we have a structural high, right? Just like this. So this is our basic market structure. So if we just play price on, what we go on to see is this, right? So now we've seen a structural shift over here. So this high has been broken. So this was rule number one, which we spoke about, right? It's very important to get your market structure down. I have made separate videos on market structure, which I recommend people checking out, right? Now, number two, I want to bring to people's attention fair value gaps. Now, we had one over here. For those who are sharp-eyed, you would have seen we had a fair value gap over here. So this is the first a bullish POI, or the first demand zone, right? Notice how price came into this region. There's a fair value gap over here to the left. So let's label that. This is a demand zone as it left a bullish fair value gap, a bullish inefficiency, right? So we see an imbalance between buyers and sellers in that particular region. So now from here, if we just clear this up for clarity, notice how price has left another fair value gap just over here in price, right? We see another inefficiency over here. So if I were to zoom into price, people can get a better understanding of the inefficiency. We see an inefficiency just over here, right? And a question I often get from students is, how do I actually mark out the candle responsible for the POI, right? The bullish POI. Now, what you want to do is you want to look at the last candle or the last area or the last wick or the last range or pivot, bit of a mouthful, before the fair value gap itself, right? So again, The fair value gap is over here. A lot of traders get this mixed up, right? This is the fair value gap, not the demand zone. This is the demand zone down here. This is an area of interest or a point of interest, right? So we can label this POI or point of interest, right? So once we have that in place, we understand it's near the fair value gap, right? So let's just play price on and understand what our third and final rule is, which of course is the concept of premium and discount, right? So now that we've seen price given us that new structural high, we have a dealing range to work with. We have a dealing range low and we have a dealing range high, right? Dealing range low, dealing range high, right? This is how we simply project the Fibonacci tool. Now, once we have that in place, again, we have the equilibrium over here. So this is the EQ, and anything below that is our discount, as we established in the schematic, right? So from here, if you are a swing trader, a long position would be valid from this region, right? So you can potentially take a long position from here and target the roughly equal highs up here, right? So this is essentially how that trade could have panned out. But again, let's look at inducement, right? Inducement doesn't have to be equal lows like we discussed earlier. This here is very clear trendline liquidity. So it's understanding that liquidity and fair value gaps work hand in hand together. Notice how we have a trend line over here. This is a large liquidity pool over here. This is sell side liquidity, right? This is what we mean by inducement. Inducement is essentially liquidity dropped before a point of interest or liquidity near a fair value gap, hence a point of interest, right? So if we were to simply swing a position from here, again, this is just pure hindsight really, but it's to get people to understand the rules, right? Notice how we've had a break of structure, we've had an inefficiency, we're in the discount, 3 rules to a POI paired with liquidity. So this is internal range liquidity as it's internal to the leg, right? This is the leg, we're inside the leg. So this is what we call IRL, right? Internal range liquidity. External range liquidity would be these equal highs over here. This is external range liquidity. So if I were to just play price on, we can understand how you could have taken a swing on this potential position, right? So when price does eventually tag us in, right? Price does mess around with the daily POI. Remember, this is a daily POI, so you can take intraday lower time frame positions off this POI, but eventually we see price does go on to hit our overall target, right? So this is a bullish example of a POI. Now, simply from here, we flip this example on its head, and we're now going to look at the bearish POI very quickly to understand, right? So again, our market structure itself has to be bearish, right? So we see price giving us lows, and we see a break of structure over here. Price then retraces into a premium fair value gap before ultimately heading lower, right? So again, how do we mark this out? How do we understand this conceptually from a point of interest perspective, right? We have a supply zone over here. Now this supply zone now is going to be in red. Notice how price engineers a swing high and price engineers a swing low, right? External range liquidity will be the trend line price leaves over here. Internal range liquidity or inducement will be the liquidity dropped just below the point of interest, right? So now let's go and understand a bearish example on the charts, right? So again, this is euro dollar on the daily time frame. Now, if we were to dissect one particular case study, it would probably be this over here, right? So let's quickly go into price action over here, right? So again, let's understand where we were in this region, right? So from here now, notice how we had structural highs and lows over here. So we had a structural high, then we saw price giving a structural low, right? Then we see price giving a structural high and one more pullback structural low, right? So from here now, first we see the shift of market structure. So we've seen a very clear shift of market structure over here, right? So we've seen price go from bullish to bearish. So that's essentially the first structural break over here, right? Now the second break we want to be looking at is understanding again markout structure. So now we have a structural high, and we see price giving us a structural low, and we see price giving us a structural high, right? So we see all of the inner workings for structure working out in our favor, right? Bearish structure, which leads to bearish inefficiencies. And now from here again, we project the Fibonacci tool from that swing high down to that swing low over here, right? Notice how the same thing happened over here, right? So again, we had price giving us, let's just replay price again. When we had a low that got produced over here, again, we had a structural high and we have a structural low, right? So notice how from here we had price filling in the fair value gap or the inefficiency over here, which is exactly what you want to be looking for, right? You want to see price come in. You want to see price come into a premium in this case, right? Price comes in, fills the majority of this inefficiency over here. As you can see, fair value gap or FVG filled. right? The fair value gap was filled over here, and then price did race lower, right? So again, from an inducement standpoint or a liquidity standpoint, this is what we're looking for. We're looking for this kind of trend line to be swept. So we see a trend line that gets produced near the equilibrium just above it. We see a fair value gap mitigated with this wick over here. So this is what we call the mitigation of the wick. Sorry, I was going to say mitigation. Made up something there. So then then we see price eventually breaking structure to the downside, right? And now we just repeat the same cycle again, right? So notice how we have inducement in the form of equal highs. Equal highs over here. We have a fair value gap just over here, right? Inefficiency here and inefficiency here. So I want people to understand the inner workings of the market, because this happens on every time frame, every pair, every trade, every session almost, right? So again, notice how price comes into our respected POI. So again, let's just clear the chart up. Here is our POI over here. Again, we're in the premium. We have a fair value gap over here. So our bearish POI is essentially going to be this over here, right? So this massive candle over here is our bearish POI. So we see price essentially just missing it, I believe. But ultimately, the markets aren't always perfect. But we understand we've hit it, we've hit it, we've hit it. So we've just about melted from that region, right? So again, understanding bearish points of interest are just as powerful as bullish points of interest, right? So this is the main objective I wanted people to understand when it comes to understanding the overall point of interest selection, right? So again, we had a bullish point of interest over here. Internal range liquidity also counts as inducement, as it's just below a point of interest. So if you like this video, give it a like, give it a thumbs up, and let me know in the comments what else you want to see. I'll be more than happy to help as much as I can.